Yes, now we are going to discuss International Financial Reporting System. Okay, International Financial Reporting System or International Financial Reporting Standard. Uh, why it is used worldwide, that we are going to see today in this class, and we have to also understand the meaning of accounting standard and how accounting standard is different than international financial reporting system, and there are certain Indian accounting standards as well that we are going to see. Okay, so first thing we have to see the introduction part of international financial reporting system. Okay, so as the name itself suggests, international financial reporting system is nothing but it is one rules and regulation which governs the accounting policies. It governs the accounting practices carried by the organization. Okay, so it is accepted worldwide. Okay, it is accepted worldwide since the public wants a financial disclosure of all the information, since public wants financial reporting of company's performance. So, in order to do this, international financial reporting system is necessary, isn't it? Similarly, international financial reporting system helps in bringing out corporate transparency. Okay, so what do you mean by transparency in accounting or transparency in transaction? So transparency is nothing but the disclosure of all the material facts and not hiding any detail, and showing true and fair view of financial position of the business. So that is the main intention of international financial reporting system. Okay, then it also makes sure that there is a uniformity in accounting practices. Okay, so what do you mean by uniformity? Uniformity is nothing but same method or procedure is followed year after year. And whenever we talk about organization, there can be small scale organization or there can be large scale organization, but it entirely depends on that particular organization, which type of policy they are going to follow and how uniformity they are going to maintain at the time of following the policy. And it also relates with the corporate ethics as well. Okay, why? Because ethics, we know that it is a set of behavior which states that what is the right thing and what is the wrong thing. Okay, basically IFRS states that what are the right way of doing things in the business. Okay, or what are the right way of carrying accounting activities in the business. So that is the meaning of IFRS. So now, after understanding IFRS, next thing we have to see here, that is accounting standard. So what do you mean by accounting standard? So accounting standard, again, it is a set of rules and regulation. When we talk about accounting standard, it is a set of rules and regulations, and it is given by some professional bodies. And why it is given by some professional bodies? Because professional bodies make sure that there is a uniformity in accounting system between two or more organization, or between the organization of two different countries. Okay, so basically accounting standards, it is based on conceptual issues. Okay, it focuses on disclosure of accounting policy. It focuses on how to carry out the business in the long run. So this is about accounting standard. Okay, so accounting standards are given by different countries, and in different countries there are different organization which gives accounting standard. So here there is one organization, International Accounting Standard Committee, IASC, and it is established in the year 1973. Okay, so this IASC implements the accounting standard all over the world. But in India, what happens? ICAI is there, Institute of Chartered Accountant of India, and this body constituted one board, that is known as the ASB, Accounting Standard Board. So in short, we can say that Accounting Standard Board in India gives Indian accounting standard. Okay, then there is one more concept that everyone should know, that is known as gap, generally accepted accounting principle. Gap means what? Generally accepted accounting principle. It is basically a narrower point of view if you compare to IFRS system. However, it is a set of rules and regulation that the company needs to follow when they do the transaction, or when they do accounting activity, or when they do accounting treatment. So meaning of international financial reporting standard. Okay, so here IFRS, see this, it is an international standard and it provides guidance on how different transactions should be reported by the company in their financial statement, which is used in many countries. That means IFRS is globally accepted, and IFRS is having the existence in more than 123 countries. That is why there is a more scope for IFRS. Okay, but if you see Indian gap, what happens? Indian gap is accepted in India only, isn't it? Why? Because it is given by accounting standard board set up by ICAI, and it is developed by Ministry of Corporate Affair. For that reason, Indian gap is having narrower scope. Okay, so now IFRS full form, I hope everyone knows here, that is International Financial Reporting Standard. So, and what are the purpose of bringing this IFRS? Purpose is nothing but to bring the uniformity in accounting system, and to bring the transparency in accounting system, and to make the books comparable, understandable, and reliable, and relevant information is available to the internal user as well as external user. Okay, what do you mean by internal user? Internal user, whoever in the company, if they want to know about the financial affairs of the company, they can easily go through the books of account. Similarly, external user is nothing but various stakeholders of the company. Even they are the interested parties, isn't it? So they may go through the books of account, and if company's books of account is as per IFRS, then uh, there is 100% guarantee can be given that everything is proper, or everything is all right, isn't it? So here there is a international accounting standard board, that is IASB. Generally it gives IFRS. Okay, that is international financial reporting system. And what are the objective of IASB? So for every objective, one thing you have to remember: one is transparency in presentation of financial information, and second one, consistency. Okay, transparency must be there and consistency must be there. How you can achieve the consistency? Consistency can be achieved by following the same methods every year, by following the same practices every year. Okay, by that way you can achieve the consistency in a financial system, or in the case of accounting. So that is one more point here you have to understand. So now, after understanding IFRS and Indian accounting standard, next thing you have to understand here, applicability of IFRS in India. Okay, so when we talk about IFRS applicability, first thing we have to understand economy. Okay, so what do you mean by economy? See this, as the market expands globally, the need for a global standard also increases, and implementation of IFRS will benefit the economy by increasing the growth of its international business. So, in other words, what you can say here now, no, we know that that economic system. Okay, the economic system has a lot of competition. In this economic system, we face several problems, and there is a global competency is there in this economic system. So if we are following the same old outdated accounting system, that will not work in the long run. That is why there is a need for implementation of IFRS in India, because of global standard. So, and that is a point number one. Economy, when there is a economy, then automatically there will be economic growth. Okay, that is one more reason for implementation of IFRS in India. Second one, investor. When we talk about investor, there can be domestic investor and there can be foreign institutional investor. So if someone who is there in abroad wants to invest in India, then he wants to know how Indian accounts are maintained, or how companies transactions are maintained. And if it is maintained as per IFRS, then of course he will be interested in investing his money in Indian companies. So that is why, from the investor point of view, as well, IFRS implementation is necessary. Then point number three, here we have to understand from industry point of view. Okay, so in the case of industry point of view, see this, there are lot of requests coming from different industry for implementation of IFRS in India. What are the reason? Because they can raise additional fund from foreign market. So when you follow the uniform system that is there in the all over the world, in that case what happens, you can easily raise capital from foreign market, or you can demand for more money from foreign market at a lower cost, and even they are willing to give that money to the Indian companies at a lower cost. Why? Because they are following same accounting practices or procedure as per IFRS. So that is why here there are three applicability of IFRS, or three reason for applicability of IFRS in India. First one is economy, second one is investor, and third one is industry. Okay, now we have to see the objectives of IFRS, okay, or the purpose of IFRS. So one of the purpose is to bring uniformity all over the world in terms of accounting standard, in terms of maintaining the books of account, and several other things in terms of recording transaction as well. And one of the objective of IFRS includes transparency, okay, and credibility in accounting statement or credibility in accounting system. Okay, so that is one more objective of IFRS. You have to remember here. What do you mean by credibility? Credibility is nothing but it is reliable, and whenever you go through that document, it should give you some kind of satisfaction, or it should give you some kind of assurance. Then only you can say that there is some credibility is there in the case of IFRS. Okay, and so that is about objectives of IFRS. And also IFRS states about disclosure of material information in a prescribed format. That is nothing but, even if there is a small minute information happens in the business, that is to be disclosed. For example, and there is a contingent liability. Okay, contingent liability you have to disclose as a footnote to the balance sheet, because there is one convention, that is convention of full disclosure. Okay, as per the convention of full disclosure, you have to disclose all the information which are relevant to the business, which are relevant to the company. That information you have to disclose it. Okay, so now the following are the different objectives of IFRS. So what are those objectives? First one, to establish universal language for the company to prepare accounting statement. So when there is IFRS, we can say that there is universal language, or in other word, we can say that there is a common code between the companies at the time of preparing statement. Second one, to establish accounting rules and make it easier for stakeholder to interpret the financial statement irrespective of business location. So here, when you know about accounting rules, or when you know about accounting framework, then it is very easy to convince the stakeholder, and it is even easy for the stakeholder also to have the faith in that particular organization. Then making accounting statement credible and transparent. Okay, so there will not be any manipulation in the books of account. Okay, that is in the point number three. Then to assist the company appropriately categorize and report the financial data. So what do you mean by reporting the financial data? That is nothing but, we know that at the end of the year, company needs to prepare their position statement. They need to prepare the profit and loss account. They need to prepare the balance sheet, isn't it? At the time of preparation of balance sheet and for P&L account, they have to follow some prescribed format. So if it is better if they follow IFRS system. Okay, it makes international comparison and analysis very easy task. So need for convergence. What do you mean by convergence? Convergence is nothing but combining two systems together in order to have uniformity. What type of convergence we are talking about? That is combining international financial reporting standards with Indian accounting standard. Okay, so and this you have to understand. If we merge both the standards, then we can have one uniformity in the system. Or in other words, what we can say, we are slowly moving from our Indian accounting standards towards international financial reporting standards. Okay, so here when we talk about convergence, okay, there are a lot of discussions made, and even ICAI expressed their view for the convergence of accounting standard, and finally they have decided to converge international financial reporting standard with the Indian accounting standard. There are two boards, as we already know. One is ASB, Accounting Standard Board, which gives accounting standard in India, and second one, IASB, that is International Accounting Standard Board, which gives IFRS all over the world. Okay, so two boards decided together that they will combine, or they will unify this accounting standards. Okay, so now benefits of convergence. So what are the benefits of convergence we are having? First one, IFRS is uniform across the industry. When there is a uniformity is followed, it is very easy for the company to publish its financial statement. There is no confusion at all, and there is a lot of clarity will be there at the time of publishing its financial statement. Okay, so one of the importance of IFRS in India is convergence. Okay, so when you converge both the system, it makes the financial statement, or it makes preparation of financial statement is very easier, and you can compare that financial statement with other companies' financial statement. Why? Because they are also following same IFRS standard. So that is one of the benefit you will get with the help of convergence. Okay, so and there are certain applicability status of IFRS in India. So what do you mean by applicability status? So here they have decided well in advance, or there are certain predetermined rules that says where Indian accounting standard have to be followed. Okay, voluntary adoption. What do you mean by voluntary adoption? Companies can voluntarily adapt to Indian accounting standard for accounting period beginning on or after 1st April 2015. From 1st April 2015, you can voluntarily choose, isn't it, to have Indian AS with a comparative for the period ending 31st March 2015 or thereafter. However, once they have chosen this path, they cannot switch back. Okay, phase one. There are two phases. Okay, phase one and phase two. Phase one, it starts from April 2016 and ends on, and it will be there till 31st March 2017. Okay, or in other words, you can say during the year 2016-17, phase one started, and it says that Indian AS will be mandatory if these three conditions are satisfied. What are these three conditions? Company whose equity or debt securities are listed or are in the process of getting listing in any stock exchange. Company having more than 500 crore turnover, or holding or subsidiary company or joint venture or associated company covered above are included. In that case, what happens? They have to follow Indian accounting standard. Then phase two. Phase two, what happens? There are certain points which are not included in phase one. For those points here, they have given the importance. Okay, usually unlisted companies are there, right? Which are not covered in phase one or phase two. For that, there is certain limits they have set. One is their turnover must be more than 250 crore, but it has to be less than 500 crore. Then they have to follow Indian accounting standard. Similarly, companies whose equity or debt securities are listed or are in the process of being listed in any stock exchange in India, again they have to follow Indian accounting standard. Okay, so this is phase two. Holding subsidiary, joint venture, or associate companies, again they have to follow Indian accounting standard. Then applicability to insurance insurance, banking, and non-banking financial company. However, when we talk about uniformity, of course, there will be a lot of other stakeholders. They are the interested parties of the company, and they want to know about this international financial reporting system and what are the importance of international financial reporting system. Okay, so that is nothing but roadmap, you can say. Okay, so insurance, banking, and non-banking financial companies shall not be required to apply Indian accounting standard, either voluntarily or mandatory. It is applicable only to those it is mentioned in the above said points. Okay, so now, as per March 2021 updated list of international financial reporting standard, we have to remember there are certain reporting standards are mentioned. Just we have to remember the name. Okay, it is not that important from the examination point of view, but just we will see this. First, IFRS 1. IFRS 1 is first time adoption of IFRS. Okay, what is this? It states about the rules and regulation that entity needs to follow when they want to implement IFRS system in their business. Second one, IFRS 2, share based payment. Share based payment means what? It includes transaction in financial settlement. It includes transaction with employees or other parties settled in cash or in any other asset. That is share based payment. So similarly, there are n till 17 to 18 IFRS is mentioned. Third one, business combination. Business combination is nothing but any acquisition, merger, all these things comes under business combination. Then there is insurance contract. Insurance contract, we know there are two party, isn't it? One is insurer and second one is insured party, and there is one concept that is known as subject matter or insurable interest, and contract of indemnity also comes in the case of insurance contract. IFRS 5, that is non-current asset held for sale and discontinued operation. Okay, in the case of non-current asset, or in other words, you can say fixed asset, that comes under IFRS 5. IFRS 6, that is exploration for and evaluation of mineral resources. Just you have to remember the name, and this is not that important from the examination point of view. Then IFRS 7, that is financial statement. IFRS 8, that is operating segment. IFRS 9, that is financial instruments. IFRS 10, consolidated financial statement, that is combined you are preparing the balance sheet of two or more companies. IFRS 11, that is joint agreement. IFRS 12, that is disclosure of interest in other entities. IFRS 13, that is fair value measurement. IFRS 14, that is regulatory deferral accounts. Okay, so then there is IFRS 15, that is revenue from contract. IFRS 16, that is about lease financing. IFRS 17, that is insurance contract. Okay, so total how many IFRS are there, or how many criteria they have made? 17 criteria. Okay, for every criteria they have specified certain rules and regulation that is mentioned in detail, that you can go through. Okay, 1 to 7. So these were the IFRS issued by IASB, that is nothing but International Accounting Standard Board. So, the International Accounting Standard (IAS) was issued by the predecessor body IASC between the year 1973 and 2001. In our country, Indian Accounting Standard IA, that is Indian AS, are issued by ASB. That we have already discussed. ASB issues Indian Accounting Standard, IASB issued IFRS. Okay, then there is a gap. Okay, Indian gap is there. Similarly, US gap is there. That is generally accepted accounting principle. So in every country, their own control system issues certain rules and regulation. That is known as gap. Okay. So now next thing here we have to understand difference between IFRS and gap. So first you have to see IFRS means we know the meaning. Then gap stands for generally accepted accounting principle. So, GAP is a set of accounting guidelines and procedure used by the company to prepare their financial statement. So, that is nothing but frameworks, you can say, systematic frameworks given by certain institute that is to be followed by everyone who is carrying similar trade. So IFRS is based on the principles, whereas GAAP is based on rules. Okay, so there are different types of GAPs are there. So generally accepted accounting principle. First one is US GAAP, that is given by America, and that is applicable to only United States. Similarly, there is Indian GAAP that is applicable only to India. So local versus global. Difference between IFRS and GAAP, which is local? Local is GAAP. Which is global? IFRS is global. Rule versus principle, which contains rule? GAAP contains rules. Principle, which it contains? IFRS contains principle. Inventory method in both the rules, or in both the principles as well as rule, they have mentioned certain inventory methods. For example, when there is a FIFO method, both GAAP and IFRS allow FIFO method. FIFO method means first in first out method. Then there is a weighted average cost method, specific identification method for valuing inventory. However, GAAP allows LIFO method. LIFO method, last in first out method, which is not allowed in IFRS. IFRS allow FIFO, but GAAP allows FIFO as well as LIFO method. Okay, then inventory write down reversal. So what do you mean by inventory write down reversal? Just you see, both the method allows inventories to be written down at their market value. Generally there are two types of value, cost or market value, whichever is higher. Okay, so both the method says that it is better to record the inventories at their market value. If the market value increases, then only IFRS allows the earlier write down to be reversed. So if you have written down any value, then that can be cancelled off in the case of IFRS. In GAAP, there is no such provision is provided. Okay, that is point number 4. Then point number 5, fair value revaluation. IFRS allows revaluation of following assets at their fair value. Similarly, GAAP, it restricts the fair value revaluation continuously. Impairment of losses. So when we talk about impairment of losses, both the standards allows recognition of impairment of losses for long-lived asset when the market value of an asset declines. When does the market value of the asset declines? Usually in the case of depreciation, isn't it? Gradual decrease in the value of the asset due to wear and tear, isn't it? Then the market value of asset automatically declines. When the condition change, IFRS allows impairment of losses to be reversed. Okay, whereas GAAP does not allow it, because it follows conservative approach, or in other words we can say it follows protective approach in the case of GAAP. Then there is intangible asset. Intangible asset which cannot be seen, which cannot be felt, which cannot be touched. Okay, so yeah, again there are certain difference in the case of treatment of intangible asset in the case of IFRS. IFRS treats intangible assets such as development cost are capitalized under IFRS. Okay, capital expenditure, whereas GAAP treats costs as expenses, or they treat this as a revenue expenditure. Okay, so there is one software for so they have mentioned internally developed software. For that software, it will be used externally, and the costs are capitalized once the technological feasibilities has been demonstrated. So in short, what you can say, intangible assets are treated differently in the case of IFRS and US GAAP. Fixed asset, again, fixed asset, where when we talk about fixed asset, it is those assets which are held in the business not for the purpose of making sale. In GAAP, it is valued at historical cost, whereas under IFRS, it can be valued at a cost basis or on market value basis. Similarly, investment property, what you can say, IFRS, it can be defined as a property held for rental income, investment property, whereas under GAAP, there is no such definition is mentioned. Okay, investment property is initially measured at cost, and later on it can be subsequently revalued at market value. That is about investment property. Then lease accounting. What about lease accounting? In the case of lease accounting, we know that while the approaches of GAAP and IFRS share a common framework, there are few notable differences. Lease accounting, there are two party. One is lessor and second one is lessee. Lessor gives his asset to the lessee for the use for a certain period of time, and of course, lessee need to pay some rental benefit to the lessor. Okay, so that is lease accounting. That is point number 10. Then next thing we have to understand the difference between IFRS and Indian GAAP. So till now we have understood the difference between IFRS and US GAAP. So now Indian GAAP is a GAAP created by Indians, or it is a GAAP created by Indian body, okay, and it is applicable only to India. Okay, again Indian GAAP is certain rules and regulation followed within the boundaries of India only, and these principles are developed by MCA. MCA is nothing but Ministry of Corporate Affairs. Okay, followed in India only. So now basic points of difference are there. First is meaning. IFRS, it is globally accepted, whereas Indian GAAP accepted in India only. Developed by who develops IFRS? That is IASB, International Accounting Standard Board. Whereas GAAP is developed by MCA, that is nothing but Ministry of Corporate Affairs. Disclosure, what you have to do? Disclosure, company that is complying with IFRS need to mention that they are following international standard, whereas company which are following Indian GAAP, they need not mention that they are following Indian GAAP, and it is understood that they are following Indian GAAP. Okay, only those companies which are following IFRS need to mention specifically. Adopted in more than 123 countries, whereas Indian GAAP is adopted in only one country, that is in India. How to adapt it for the first time? In Indian GAAP it is not mentioned, but in IFRS it is already mentioned in IFRS 1. That is nothing but implementation of IFRS. Then use of currency in the presentation. Okay, so when we talk about currency, we have to understand exchange rate fluctuation, isn't it? So when the financial statements are not presented in functional currency, then the assets and liabilities of the balance sheets are transmitted by exchange rate. So exchange rate, a question of using the exchange rate, since Indian GAAP is only used in Indian context, so there is no question of using exchange rate. Whereas in the case of IFRS, there is a more scope for exchange rate concept. Then consolidated financial statement, company don't come under the exemption criteria of IFRS, and they have to prepare consolidated statement. But as for Indian GAAP, okay, they have to prepare individual statement rather than consolidated statement. Then there is a type of financial statements. So when we talk about types of financial statement, there are two financial statement we know. One is position statements such as balance sheet, and income statements also known as profit and loss account. So but Indian companies following Indian GAAP, they have to prepare balance sheet and P&L and cash flow statement only. Cash flow statement, it is given by accounting standard 3. Then how is revenue shown? So revenues can be shown at their fair market value, and it can be shown as a receivable as well. Money charged for the product and services to the customer, and the reward received by using the resources come under the revenue as per Indian GAAP. Okay, so that is point number 9. So I hope all of you have understood what are the main point of difference in the case of Indian GAAP and International Financial Reporting Standard. Okay, so in this chapter, this is a small chapter, that is International Financial Reporting Standard. So what are the important topics you have to focus on? First one is, what do you mean by IFRS? Second one, you have to understand what do you mean by Indian Accounting Standard. Third one, you have to understand what do you mean by GAAP. Then fourth one, you have to understand what do you mean by Accounting Standard Board. Then International Financial Accounting Board, you have to understand. Then what do you mean by convergence and applicability of IFRS, you have to see. Then difference between IFRS and US GAAP. Then difference between IFRS and Indian GAAP. So okay, so I hope this is clear to everyone. So thank you so much. We'll see in the next class.